Our next speaker will be Albert Martinez with Essent Guarantee. He's the account manager for the HFA East. Albert has been involved in the mortgage lending industry since 1997. Prior to joining Essent, he was with a major nationwide lender where his primary focus was helping low and moderate income communities and serving emerging markets. He worked with realtors, builders, sales partners, housing counselors, and housing finance agencies to fulfill his previous roles' goal of providing low and moderate income homebuyers with mortgage products designed to help them achieve homeownership responsibly. Albert currently serves on the leadership committee of the National Association of Hispanic Real Estate Professionals in South Florida and is a board member of the Housing Counseling Agency and nonprofit Real Estate Education and Community Housing. Albert joined Essent Guarantee, Inc. in 2017 as the account manager for Southeast Florida and is now also part of the HFA support team and serves the Eastern U.S. Albert will be joined with Siobhan McCreevy, who is a sales support manager at Essent Guarantee and part of Essent's HFA support team. Thank you so much, Albert and Siobhan, for joining us today, and you may start your presentation.
Thank you, Tony. Big thanks to Carrie, Kathy, Alabama HFA for having us on this morning. As Tony mentioned, I'm Albert Martinez. With me this morning, or this afternoon, I should say, if you're in Alabama, I have Siobhan McCreevy. Siobhan, hello, how are you?
Hey guys, how you doing?
All right, so Siobhan and I were part of the Essent HFA team, and what we'd like to do this morning, our goal is to help you understand how to think outside of the box as it relates to mortgage insurance, right? Because forever and a day, we've been using the monthly mortgage insurance option for over 90% of transactions across the US. Well, we want to try and help you think outside of the box. And before we move on, I just want to give you some context in case you're unaware, is Alabama HFA, Freddie Mac's HFA Advantage. You're going to hear from Jim Hall in just a minute. He's up next. Essent MI, we all work together to help your buyers, your borrowers get into low down payment mortgages while using the down payment assistance that's available to them through Alabama HFA to get into homes they can afford. Okay, so that being said, let's go ahead and talk about how we can use MI creatively to get your buyers, your borrowers into homes they can afford. So first off, we're going to talk about a quick overview here. The monthly product, this is the first and the last time you're going to hear me mention, is it's the most common product. It's the most popular MI product by far. It's been around forever and a day. Everyone pretty much on this call knows about it, how it works. What we're going to focus on today is single premiums as well as split premiums. And these are sort of outside of the box because they're not as common as the monthly option as you can imagine. Now, to help us unpack this, I'm going to go ahead and turn it over to Siobhan, where she's going to talk about single premiums first.
Thanks, Albert. So a borrower paid single might be a good choice for a home buyer who wants to keep their monthly payment low, as it often provides the lowest monthly payment of any MI option available. With a BP single, that full premium is paid in its entirety at closing, and it can be paid a few different ways. The full premium can be paid by the home buyer, but this is obviously going to result in higher closing costs for the home buyer. It can be financed either in whole or in part. Generally, with finance single premium, principal and interest payments will be lower than if the MI premium is paid monthly. But you need to ensure that you're in compliance with GSE guidelines for LTV because a finance premium will increase the loan amount. The seller or builder can pay the full premium upfront, but when you go with this option, you have to ensure that you're in compliance with interested party contribution guidelines. And then finally, and this is a nice option, especially when you're structuring HFA loans, the upfront premium can be paid using a part of the down payment assistance funds. So, in short, a BP single could be a great option for a home buyer. But, if paying the MI premium in its entirety at closing isn't feasible or isn't a good option for a borrower, a split premium might be a good alternative. So the split MI premium option is a really neat product because it really offers the ultimate flexibility when you're structuring a loan with MI, because the MI premium cost is divided into two parts: a single upfront premium payment ranging from 50 basis points to 175 basis points, and a monthly MI premium that's generally going to be lower for the home buyer. Just like with a BP single, that upfront portion can be paid several ways. It can be paid by the home buyer, can be financed into the home buyer's mortgage by the lender or the seller. Or I'm sorry, it can be financed into the home buyer's mortgage, or it can be paid by a third party, the lender or the builder or the seller. Or, and again, this is really key, it can be paid using your DPA funds. And then there are a few key benefits that come along when you're using a split. The range of upfront premium amounts and the variety of payment options for that upfront portion really offers some flexibility when you're trying to find an MI product that works best for a specific home buyer scenario. And then because you have that upfront component, the monthly MI premium is lower, which is going to help you qualify more borrowers. And then finally, it competes with FHA, and we'll walk through a specific scenario of how a split and an FHA loan compare in a few slides.
Okay, so just like any interview, any transaction as salespeople, we want to make sure that we're asking a lot of questions to help identify the needs, right, of your borrower, of your buyer. So what are some of the questions that we want to ask in relation to mortgage insurance? So what is it that they're looking for, right? Is it the smallest down payment? Is it the least amount of funds for closing? What about the lowest monthly payment? That seems to be popular too, right? And then, of course, some follow-up questions. How long do they plan to be in the house? And as Siobhan just mentioned, the single premium, the split premiums, they pretty much often help reduce the debt to income ratio. As we've been talking about, the panel has for the last hour or so that we've been on, affordability is an issue. Purchase prices, median prices, they keep continuing to increase, right? And so those options, single and splits, can help with debt to income ratio if you're just slightly over the maximum DTI. So, Siobhan.
And then there's one really key additional benefit of borrower paid MI, and that's that unlike FHA mortgage insurance, BPMI can be canceled. And that's a really good thing because it can lower a home buyer's monthly mortgage payment, which can really add up to significant savings in the long run. So the Homeowners Protection Act, the HPA, covers residential mortgages with BPMI. So mortgages to finance the purchase, initial construction, or refinancing of a single family dwelling that's the primary residence of your home buyer. And then BPMI can be canceled, first off, at the request of the servicer at any time. This is pretty key because MI providers do not determine if and when MI can be canceled. BPMI can be canceled at the request of the borrower when the LTV based on the original value reaches 80%. And then finally, your BPMI is going to automatically cancel when your LTV based on the original value reaches 78%. So just another really nice feature about borrower paid mortgage insurance.
Yeah. So Siobhan just gave you a high level overview of the way that singles and splits work. Let's go ahead and do a deep dive now. On a scenario. Go ahead and let's take us to the next slide here so we can show everybody. This is a borrower paid single premium that is being compared to an FHA scenario. And here's some of the assumptions. We have a purchase price of $250,000, which is very relevant in your market. 97% loan to value, 720 FICO score. And again, the MI premium here being paid by the borrower, the lender, or the seller. Over on the left, you're going to see the loan and MI details. Towards the middle of the screen, you're going to see the Essent borrower paid single premium scenario. And then over to the right, you'll have FHA. Now, first, you're going to see the upfront premium rate of Essent for the single premium is 2.75% compared to FHA's 1.75. And now you're saying to yourself, well, Albert, 2.75 is higher than 1.75. What's going on here? Well, let's move on to the next line where you have the ongoing premium rate. As you can see, NA, not available. It doesn't exist. There is no monthly mortgage insurance payment when you pay a single premium upfront versus FHA's 85 basis points, and I don't want to steal my own thunder here, but 85 basis points for this scenario is $171 a month for the life of the loan. If we move on, you're going to see the total loan amount, pretty similar, 242 to 245. You do see an increase, though, in down payment and upfront MI at $14,000 compared to almost $9,000. However, you're going to see that at the end of the day, the monthly savings over FHA is $132 a month. And this is really significant, right? Because you can either, as a borrower, pocket these $132, or as we've been talking about again, the market that we're in, we now have $132 in purchasing power that we did not have before. Okay. Thank you, Siobhan.
Okay, so I said earlier, the nice thing about splits, it really competes with an FHA loan. So here we have 3 split premium options as compared to FHA. Again, we're assuming a $250,000 sales price where the borrower puts down 3% and the upfront portion of the split is going to be paid either by the borrower or another party. So in scenario 1, the borrower or the lender or seller has an upfront of 125 basis points and their ongoing monthly MI premium is 66 basis points. The 3% down payment plus that upfront amount is going to be $10,531 that either the borrower or another party has to put down at closing, or it can be paid with the DPA funds. The monthly P&I is a little over $1,200, and the monthly MI payment is $134, which brings your monthly payment in at $1,344. And this is really within striking distance of what the borrower would pay with an FHA loan. But the key thing here is you have to remember that unlike FHA, borrowers can request to cancel S&MI once their LTV reaches 80%. So if you assume a 2% annual home appreciation, your MI could be canceled in 61 months, which would result in a savings of more than $132 a month over FHA. And then in scenario 2, the borrower or another party is going to put down a little more upfront. So in this scenario, the borrower has an upfront premium rate of 150 basis points, which makes their ongoing monthly premium 62 basis points. Again, your upfront plus your down payment that needs to be paid at closing is a little over $11,000. The monthly P&I is still $1,200, but your MI payment is now $125 a month because that borrower has that higher upfront premium rate. And this is going to bring your monthly payment in at $1,336 a month, so a $7 monthly savings over the FHA option. And then finally, in our last Essent split scenario, the borrower has an upfront premium rate of 175 basis points, which you can see is equivalent to the FHA upfront premium, and their monthly premium rate is 58 basis points. So that upfront plus the down payment that needs to be paid at closing, or again, hopefully with the help of DPA funds, is going to be $11,744. Again, your monthly P&I is $1,211, but the ongoing monthly MI payment is going to be $117. So in this last scenario, that borrower's monthly payment is a $15 monthly savings over the FHA mortgage insurance option. And what both of these scenarios kind of go to illustrate is that essentially there are several ways to structure a loan with S&MI that leaves the home buyer in a better financial situation than they would be with an FHA loan.
Thank you, Siobhan. Okay, so now let's talk about some of the resources that are available to you. Some of them are going to be specific to the loan officers on Zoom right now, but we do have something coming up for realtors that we feel you're going to find very interesting. So let's talk about Rate Finder. As a loan officer, sometimes you're on the go and maybe you don't have your loan input into your loan origination system just yet. And you want to have an idea of what the monthly or the single or the split premium mortgage insurance is going to be for your pre-approval, right? So what you can do is you can visit our website, essent.us, and we're going to have our website listed on the last slide, and you can access Rate Finder there. So Rate Finder is going to help you with a quick quote, or it can also help you if you want to compare multiple products side by side. As a matter of fact, over here on the right, you're going to see that we have 3 different options available. We have the more traditional deferred monthly example. We have an FHA scenario. And then last but not least, we have the single premium all lined up here side by side. It gets even better because let's say that you want to include split premiums, which are not here listed right now. You can do that because we can compare up to 5 different scenarios at one time. Now, what you can do with this is you can save it, you can print it, you can email it to your borrower and have them take a look for themselves and make an informed decision on what they would like their future to look like with mortgage insurance. Okay? Thank you, Siobhan. All right, so we've talked about the different structures for mortgage insurance. We talked about the singles. We talked about splits, a tiny little bit about monthly. We talked about Rate Finder, that tool where we can, that I just spoke about. We can compare multiple products at the same time. Now we're going to shift gears on you a little bit, and we're going to talk to you about an award-winning tool that Essent has available to agents, to loan officers, to borrowers. And let me start off with a question. How many of you have been sitting across the table from a borrower, from a buyer, and their thoughts about their next transaction are maybe like, you know what, I'm going to just go ahead and wait. I don't want to pay for that PMI, whatever that is. I'm going to wait till I have 20% for my down payment, and then I'm going to go ahead and purchase my first home. Or what about those that say, you know what, rates are up. They're on the way back up, but guess what? Maybe about another month or so, they're going to be on the way back down, so I'm just going to wait. Well, what Sniq does for those types of situations, it illustrates to the potential home buyer what it is that they leave on the table when they don't buy today. In dollars and cents, what it is that they leave on the table when they don't buy today. So just to follow along here, you can create customer-specific solutions. It takes seconds, literally, just a few minutes, how to show the opportunity cost of waiting to save up for that 20% down payment. It projects how quickly homeownership can build equity, wealth accumulation with as little as 3% down. It calculates a long-term savings of paying a mortgage versus paying that rent payment at the end of the month. And then, of course, it determines the monthly mortgage payment, including the Essent MI. It's available on our website, essent.us/SNIQ, completely free to use, no credentials necessary. And you can share this with agents if you're LOs. If you're LOs, you can share this with loan officers, with agents, with borrowers as well. Borrowers can actually access this and play with the numbers themselves. It's available in English and in Spanish for those who prefer to speak or read in Spanish. And it's built for desktop, but it's available for your tablets as well as your smartphones. You can take the feedback certificate that is generated, and this is probably not going to come out very clearly, but this is a sample here of what it looks like. And it's not doing it for me, but what I'm going to do is I'm going to describe it for you. So this PDF certificate, oh, there it is. This PDF certificate that you're looking at right now is completely co-brandable. As you can see, we have Rihanna Realtor on the left. We have Leonardo DiCaprio, Leo Lender on the right. And what this is going to do is, again, it's going to illustrate the opportunity cost of not buying today. So with this particular scenario, I'm going to just quickly read. It says, based on your monthly savings pattern and return rate, it take you 15 years and 6 months to accumulate 20% for a down payment. At that time, you'll pay $323,000 in rent versus buying now and earning $205,000 in equity and property appreciation in your home. You can request cancellation of MI when the loan to value ratio drops to 80%. So 12 data points. That's it. For example, how much do you have for a down payment? What are your monthly savings? What will your mortgage look like when you eventually close? With those 12 data points that are involved in the questions that I just asked, this feedback certificate is generated. Now, so one of the best practices out there that we've heard from agents is they will go ahead and print 25 of these as an example and leave them on the kitchen table for their next open house. So now their walk-ins have something to take with them, with property information, with the agent's contact info, with their partner lender on here as well, in case they have any follow-up questions. It's free. All it costs is the paper and the ink that it's written on or typed on. And the other question or the other best practice that we hear a lot about is loan officers will just print a bunch of these, keep them on their desk. And if they ever have the objection of, you know what, I'd rather wait to save up for 20%, or I'm thinking that rates are going to go back down, here's an illustration, sir. Here's an example of what the cost is to wait when you end up doing so. So that's SNIQ. Again, it's available on our site. I'm going to go ahead and turn it back over to Siobhan so she can close us out now.
Yep. I just want to thank you guys so much for your time and attention. If you have any questions or want to discuss your options when you're structuring your next deal with MI, please don't hesitate to reach out to either Will Landis, our fantastic account manager covering Alabama and Mississippi, or Candace Racine, our equally amazing regional vice president who covers the entire Southeast. Thank you, guys.
Thanks, Siobhan.